A fever spike is rolling through speculative tech. Not a cardiac event, but the precursors are forming. Cloud financing questions hit Snowflake and Nebius, hard enough to drag the broader AI sector down with them, while oil prices ignite an inflation hedge response that's already bleeding into your equity positions. The question isn't whether the infection will spread, it is what collateral you lose before containment begins. The data is screaming about rotation out of risk. Not panic selling, but disciplined deleveraging. Your speculative exposure is coughing as RKK and SPHB both shed ground while SMH barely flinched. This distinction matters. Your core engine, SMH.5, remains stable while the peripherals burn hotter. The consensus among the Canary community is that this resembles 2018's late-cycle tech purge, valuation re-rating, not fundamental collapse. Credit conditions are tightening faster than headlines suggest. Nebius down 4%, Cloudflare and Snowflake, both slipping on financing concerns, means your high-growth cloud exposure faces a liquidity headwind. The data confirms this. XBI hammered 6% as biotech leverage capital seeks cheaper funding, while IWM dropped 1.41%. Your mid-cap exposure is running hot because smaller companies depend more heavily on credit markets that are visibly contracting. Fear isn't climbing, it's building immunity. UVXY gained 2.26% as hedgers bought protection before the full cascade, but VIX only climbed 7.59%, not double digits. This is controlled stress. Investors are running hedges rather than fleeing assets entirely. The indicators show fear concentrated in speculative tech. MAGG's won 37 plurals, while consumer staples, XLP, barely moved despite the sell-off. Your portfolio's defensive layer is functioning as designed. Oil jumped 2.55% to $86.54. This is your inflation headline disguised as energy news. When crude surges into the mid-80s, manufacturing costs rise and margins compress across industrial names. The real economy section connects. Higher oil, higher yields 10Y at 4.7%, lower discount rates. For growth stocks, valuation pressure on exactly what's bleeding today. Your equity exposure faces a dual threat from above. Gold climbed to $579, while TLT slipped 7.8%. Your traditional safety rotation is active but incomplete. GLD gained 0.4% as capital sought non-yielding stores of value, yet bond fell 0.53%. The safety trade reveals your hedging inflation, gold up, while simultaneously selling duration, TLT down. This split signal indicates investors believe the Fed will pivot, not immediately, but soon enough to make long-duration bonds vulnerable again. The hero here is your portfolio's core exposure. SMH holding steady proves your equity foundation isn't crumbling under speculative stress. The villain is inflation-anchored valuation compression, hitting high-growth tech first and spreading through credit-constrained mid-caps. Your portfolio absorbed the hit because you're diversified across sectors. XBI took the brunt while I barely blinked. The indicators confirm this is a sector rotation, not a systemic event. The fever breaks before it becomes an infection. Oil will stabilize as inflation data cools. And cloud financing concerns are isolated to two companies rather than industry-wide. Your portfolio coughed but didn't flatline. The next 3 trading days determine whether this was a mild case or something requiring antibiotics. Keep duration exposure light until yields retreat below 5%. The Canary is watching your pulse. Maintain steady breathing through the volatility.